Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
So I had a question. Somebody asked me a question. Before I forget, I will answer it. And if you got a question, there are a couple ways that you can do things around here. One of the main ways is if you know my email address, you can do that. The easier way, though, is to go to the website, paulwinkler.com/question. Or if you go on the website, there's an area on there that you can go and, you just find it. It's like under the radio show or something like that. But, paulwinkler.com/question. So the question was regarding yield curves. Now, so if you're not familiar with what yield curves are, it's not too terribly complicated. Typically what happens is this: if I borrow money for a long period of time, whoever is lending me that money is taking a risk that interest rates, that there could be a change in interest rates. And if those interest rates go up, they're taking a risk that they've lent me money at a low interest rate. And then in the future, if interest rates are higher, they're missing out because they've locked in a loan for a long period of time in a low interest rate. So long-term interest rates are typically a bit higher. If you look at like 15-year mortgages versus 30-year mortgages, you'll see that kind of thing. So typically you'll find the 30-year mortgage has a higher interest rate. So some people will go, well, I'm just going to borrow for 15 years and that'll be it. And that way I'll keep the interest rate lower. But then you run into the risk in that particular instance that you have to make those higher payments, and you may not be able to make those higher payments. Let's say if you lose a job, if you're disabled or something like that. So, a lot of times it doesn't necessarily make sense to go with a shorter mortgage, even though the interest rates are a little bit lower. But, that is just really dependent on the financial plan. But that is the idea of a yield curve. That's the ideal. The idea is that if I lend money for a very, very short period of time, the interest rate is typically lower than if I lend that money for a long period of time, and vice versa if I'm borrowing. So what happens is this: is you'll have people come out and say, well, yield curves and inversions, they're a bad thing. And the idea being that if interest rates in the short term are higher than long-term rates, it's a precursor to market downturns. I mean, that's basically what people will say is, it's a precursor to downturns. It means that the market's going to turn down. We're going into a recession. And, the thing that happens here is this. I'll get to what people are wanting, and then I'll just talk about yield curves in general. You'll have like 2-year treasuries. And if you look at short-term treasuries, like 1 month and the treasury bills, and you look at the interest rates, it's been kind of a weird thing the past few years. As I've noticed, it's been more like a smile. In other words, you had higher short-term interest rates, then the intermediates went lower, and then the long-terms were a little bit higher. So it kind of looked like a smile. Well, what happens with yield curves is typically you have this up slope. And the inverted yield curve shape is normally where those longer bonds are going to have higher interest rates. Now, it's typically talked about, if it's the other way around, as a harbinger of an economic recession. Now, here's the thing. If you look at the 4 previous recessions, the inversions, they were eventually followed by a recession. So that's why this stuff takes root. And this is why people talk about this stuff. If you have an inversion where the short-term interest rates are higher than long-term, in the past previous 4 times it's happened, it has been followed by a recession. But the link is actually not so great and very helpful for trying to figure out market movements. Now, for example, if you look at the trading days, I was just looking at some data on that. It took between 272 and 486 trading days from the inversion onset for the recession to arrive. So that takes about 2 years. So in other words, you're looking at a long time between when it inverts and when the recession actually occurs. Now, to put it in perspective, the average U.S. economic expansion has been about 5 years. So that means that the average waiting time for a recession, regardless of the rate environment, has been about 2.5 years. And 3 in 4 cases, the inversion was over before the recession even began. So you look at that and go, "Whoa, well, wait a minute. Okay, the inversion, it's gone back to normal." And then the recession starts and you go, "Well, that was real helpful, right?" And there's not a lot of evidence that inversions are cause for concern when it comes to investments because, people talk about the stock market and I'll go, which stock market? Are you talking about large companies? Are you talking about small companies? You're talking about value companies? You're talking about international value companies? You're talking about emerging market companies? Or, which ones? Which markets are you talking about? The market has, historically, it's posted substantial gains between inversion and recession in 3 out of the past 4 cases, which is what we expect, right? And you hear me say this all the time. When I'm trying to predict market movements, and if I predict that the market is going to go down, I got a 1 in 4 shot approximately that I'll be right. I got a 3 in 4 shot that I'm going to be right if I predict the market is going to go up. And that's basically what you see here. And, it's been up double digits so far during the current inversion, so to speak. Because like I said, it's been a weird one. Couple of pieces of data that you might find interesting. Because I was looking at this up really quickly before the show. Yield curve inversion, 1978. How long did it last? 988 days. Now, what happened is that you had, during that period of time to January of 1980, you had 346 trading days from inversion to recession, and the cumulative market return was 13.11%. So much for that, right? And we're just talking about S&P right here. And we look at 1988. You go to 327 days. We had this period of time of inversion to July of 1990. Trading days, 391. What was the market return that you missed if you bailed out? 32.9%. February 2nd of 2000, you had 230. Now, everybody probably remembers that period of time because it was the tech bubble. To March of 2001, 272 trading days. Now, that was the market down 14.71, but that doesn't tell the whole story. Because if you look at that same period of time, the year 2000, actually value stocks went up. And small value stocks went up. And small value the next year went up like almost 30%. Then you got December 27th, 2005. 361 trading days for inversion. To December of 2007, 486 trading days, market cumulative return, 20.91%. And, you look at it, we don't know the most recent one. We haven't finished yet. We don't know where it's going to end up. But that's the reality of things. People will use these types of things to try to predict the future, and that's the problem. It is the cycle that we go through as investors that I have to point out to people over and over again because you'll hear something. And somebody's on TV, they're telling you, hey, based on this, what's going on, the stock market's going to do this. And I have to point out, there is a cycle you go through as an investor, and it starts with a fear of the future. People are worried, especially in an election year. Oh, my goodness. What's going to happen? Where is this whole thing going to go? We hear that one of the candidates is looking at price controls, right? And you go, well, wait a minute. Last time that was tried, I remember Nixon. It didn't work so well. And then you have other people say, well, on the other side is looking at tax decreases and that could be terrible. And, people on both sides are worried about what the other side is going to do. Let's just put it that way. I try to stay apolitical on this whole thing just because it doesn't help. It's like I was pointing out to somebody who was in my office and I said, I was looking through history. I go red, Republican, blue, Democrat, red, blue. And I'm going through history. And I go red, blue, red, blue, red, blue. Mark it up. The market's just up. It didn't really matter who it was. But people say it's different this time. And I have to point out, yeah, it's always different. So you look at it and go, well, what will companies do to protect themselves from whoever is in office? Well, they will have a game plan for whoever's in office. And let's say that it's really bad for the economy. Let's say it's really bad. Then they will do everything they've got to do to reduce expenses to get earnings to go back up. But I digress. Back to the cycle. We have a fear of the future. And we want a prediction about the future. Will somebody Please tell me. And you know what? The investment industry is wonderful at coming out with some kind of a prediction as to what's going to happen. And the media will dig up somebody that predicted last time when something happened. They predicted that it was going to happen. They will find the person that predicted the future the last time successfully. So what'll happen is what they're doing is they're looking at past performance. So I have this fear of the future. I'm looking for somebody somehow, some way to tell me what's going to happen in the future. So I look for things that worked in the past. And, yield curve inversions used to work fairly well. And, at times to help predict recessions, but it didn't really tell us what the market was going to do. But people equate recession with market movements. And you go, well, markets should go down during a recession, right? Not necessarily. Markets typically go down before the recession happens. You have the bad stuff that before these things happen. It's like the 1973, 1974 downturn in the stock market was the precursor to the bad stuff that happened during the Carter years. During that period of time, it was a tough period of time. But, you look at it, U.S. markets did fairly well during that period of time. As I recall, I think it was only 1 year down for the S&P 500. Wasn't down much. But international markets just rocked during that period of time. Really well. Small caps, very, very well during that period of time. So we look for somebody that did it in the past. And then what we do is we get overloaded with information. Because everybody's talking at me and I can't hear a word you're saying. Everybody's telling me, hey, we figured this out last time. We got this person. They're really, really good. You need to listen to them because they really get this stuff. And they will speak at such a high level that you will be convinced that they know exactly what's going on and what they're doing and what's going to happen next. They will be very, very convincing. And then what happens is I get overloaded with information and I just go into shutdown mode. Just Calgon, take me away. I don't know what to think. This person's saying it's going to go up. This person's saying it's going to go down. I was talking to one of my friends, economics professor, this week. I'm over at Trevecca, President's Dinner. And I get to talking to him and Dr. Agee, and I go, that's so, what do you think? And he goes, do you believe what so-and-so said? He's talking about a really well-known economist. And he said, he just lost his mind. He admitted it. He came back, to his credit, came back on TV and said, I had just lost my mind. And I said, yeah. I said, that is exactly it. Sometimes the smarter they are, the more they think they can figure out what's going to happen next. So remember that, Princeton, I was talking about a Princeton professor. Guy's basically telling us we got to invest in Chinese stocks. You got to do this. You got to get involved in China. 2008, you got to do this. Oh, my goodness, if you would listen to that advice. How awful. Terrible. Then you have, guys like economist Harry Dent just, predicted 10 out of the last 3 recessions. Just constantly predicting
over 100% accuracy.
Oh yeah, exactly, man. I mean, he's just like, you couldn't do that any better, man. He just
10 for 3. That's
I don't know. I'm just making up the number. But you know what I mean.
300% accuracy.
It's a running joke. It's a running joke that economists, you look at their prediction of interest rate direction. I mean, seriously, it's like 70% of the time they get the direction wrong.
We have had like 20 supposed recessions in the last, 4 years now? It's been like every time I look on in Twitter or something, it goes, we're in a recession. I'm like,
yeah, man.
Okay, can someone actually confirm this now? Are we?
Totally.
I don't even know anymore. I honestly don't.
Oh, totally. Yeah. And you hear people using the stock market. It's a crash and the crash is due to this person. And I just
There was a little scare recently, though. There was little drop that freaked people out.
But the problem that you run into is you go, well, what causes the drop? People get scared and they don't put money in, or there's very little buying activity. And then when people get scared, the amount that they'll accept for the stocks that they own is much lower.
Yeah, they're selling at a fear. Hopefully it doesn't go down anymore.
And then it goes down, and all of a sudden they go, oh, the information was wrong. Bam, it goes back up.
It's funny because I was actually doing a newscast for during the weekday, and that had the day it happened.
Yeah,
so
Monday.
I'm looking at the I'm looking at the stocks, and it's going right back up. It was at I think once I finished, it was 3 hours. It was at 400 instead of minus 1300. So I was like, okay, it's gonna come back up to even. But still, it was. Well, sure. 1,300 is nothing to really laugh about. It is.
It scares people, and whenever there's more risk, people will just, and they fear, they don't know what's coming. So you don't want to step out and pay a high price when you don't know what's coming. So people will automatically drop the price that they're willing to pay. And that's when I tell people that you have the greatest wealth transfers, the people that are not willing to take risk. Give money to the people that are willing to take risk is really what ends up happening. And you look at the market throughout history. From 1963, study from 1963 through 2004. And what they wanted to know is how much of the market gain occurred in how many days. Okay, so you have all these trading days in the course of a year, right? 365 days in a year, but you're only trading, a fraction of those number of days in the year. Monday through Friday, and then you're off on holidays and things like that. But you look at that and go, okay, how many days were responsible for 100% of the market gain? The answer was that 96% of market gains were due to 0.9% of trading days. And you go, whoa, which day? Oh my goodness. You're looking 2 to 3 days per year give us all the return of the stock market. And a lot of the information that we get from day to day, from minute to minute, is nothing but noise. It's nothing but noise. And what we're doing is you have whisper numbers is what they call them. You hear information and you go, well, based on this information, this might be happening for this company over here. And people are trying to figure out proper pricing based on little hints and clues. It's like you're trying to solve this mystery and you need, 30 clues to get it solved, but you only have 2 and you're trying to figure it out. And little by little, the information comes in and you go, I know what we ought to be paying for these stocks right now because the information is clear now. Well, that new information that really drives markets doesn't come out that often. So hence what happens is for the investor trying to figure out where it's going to go, it's futility at its highest level. So we make emotion-based decisions. Since we have this dearth of information, we don't really know what's going to happen. What we do is we go, I don't know. How do I feel? That's great. I feel optimistic. Oh, then you buy when you feel optimistic. How do I feel? I feel horrible and pessimistic and nasty. And that's what the media generally tends to do. They make us feel horrible, pessimistic, and nasty. So I tell people, go outside. Only listen to this show. Go outside, walk through the grass, feel the wind on your face, watch the squirrels, watch the birds, because the likelihood of you getting something helpful from the media regarding what your investments are going to do is somewhere in the neighborhood between slim and none. So we make these decisions, and then we end up with relative losses. And this is the thing that we find with investors. The Dalbar research, 35 years. The average investor in the stock market has literally had a rate of return right around in an asset allocation portfolio, stocks, bonds, cash, about the same return as inflation. That's pretty stinking bad. And that is the reason. It's that desire for a prediction about the future and then recognizing too late that the prediction was wrong, but you made a move based on it. That is the problem. So yield curves, looking at yield curves, trying to figure out, I've talked about butter production in Bangladesh being a great predictor. Just walk away when somebody is trying to tell you what the future holds for the stock market. You diversify the portfolio based on your time horizon. There are things that you can do, but trying to figure out where markets are going to go, it is a fool's game at best. You're listening, but the investment industry plays on it all the time because, quite frankly, if they can get you to listen to their predictions, they stand to gain. You tend to stand to lose.